Hey everyone, welcome to another episode of the Investor Types podcast. Now when you think about investing, a lot of people know about investing into Australian stocks and they think about banks, they think about investing into mining companies. But what a lot of people don't think about is investing into Australian listed real estate property companies or developers. So I'm here with Mark Mazzarella, who is an expert in this field. So Mark, thanks for coming on, buddy.
Mate, an absolute pleasure.
Can you please tell me who you are, what you do, and what investing in Australian listed property is?
Sure. Well, I'm an assistant fund manager in APN Property Group's real estate securities team. So basically, what we do is aggregate investors' funds and invest that into publicly listed real estate securities called Australian Real Estate Investment Trusts. Mm-hmm. So that is basically the premise of our fund, is to put money to work into the listed property sector. But taking a step back, me personally, I suppose, I'm a property valuer by trade. So I started my career at Ernst & Young about 8 or 9 years ago, got qualified as a commercial property valuer, and then moved into sort of the finance and capital market space, and have been at APN for almost 6 years.
Right. So when you say looking at Australian real estate investment companies, so that are publicly listed, so anyone can buy them?
Yeah, that's exactly right. It's probably important to make a differentiation between a real estate investment company and a REIT, so a real estate investment trust. The real estate investment trust is basically a vehicle that's used to own the direct assets and essentially derive all of its income, or the majority of it, from the rental income derived from tenants paying rent, much like yourself in this office.
Right. So they invest into big office buildings?
That's exactly right. So from office buildings, shopping centres, industrial warehouses, right down to the more specialist classes of assets like storage facilities, childcare centres, and even petrol stations.
Right. So who are some of these companies, so people can draw sort of like an alignment?
So when it comes to office buildings, probably the largest in Australia office specialist REIT would be Dexus Property Group. So they own a number of assets in Sydney, Brisbane, Melbourne, as well as a couple in Perth. Then there's things like Westfield, so Scentre Group, the Westfield branded shopping centres in Australia.
Shopping centres, yeah, massive.
And then of course Vicinity Centres, which of course owns part of Emporium here in the Melbourne CBD, and of course the jewel in the crown, Chadstone.
Yeah, which obviously generate a lot of income from food outlets, from different retail outlets.
That's right, department stores, a whole host of different retailers, essentially.
So when you look at these companies and you try to decide how to invest into different companies, what do you look at? How do you value these things?
Well, look, the first and foremost, most important thing for any real estate investment trust investor is the income. So we have a look at what are their prospects for delivering solid, growing income at the bottom line to the underlying investor in the form of dividends. So we have a look at things like their rental income, how high that dividend yield is relative to what their share price is trading at, but also how defensive that is. Is it all coming from one tenant? Is it coming from thousands of tenants? Is it all staggered over a period of time? Is it growing? Is it indexed? So every year in Australia, a number of REITs have fixed annual rent increases, but others are indexed to, say, CPI, which of course at the moment is low. And so when you step through that, you have a look at, well, how good are the management team? What's their track record? Do they have a good leasing team? Because essentially this is about leasing space. Are they good at allocating capital? Are they buying the right buildings? Are they doing the right things in the right markets? Can they add value? Can they spend some incremental money to repaint the walls or refit a section of the shopping centre to get better retailers in and drive some more foot traffic to drive sales?
Yes, that's obviously a very high capital injection as well.
Yeah, that's right.
So these companies have to allocate money that they get in from investors between, do we buy something, do we release something, do we put a capital into it to make it look a bit nicer and try to attract even better tenants?
Absolutely right.
Okay.
Yeah.
What are you seeing some of the trends at the moment? Are they going into, is there a lot of industrial, a lot of push for industrial, retail? Is that really outperforming? Yeah,
so at the moment, I think if we want to step through the major asset classes, office has been tremendously strong, especially in Sydney and Melbourne. Not so much in Brisbane and Perth, but they're definitely on the up in those markets. So Melbourne and Sydney's very much been led by a lack of supply. So supply and demand is important across every asset or investment class. And basically you've had a situation in Sydney and Melbourne where supply has been relatively constrained for a whole host of different reasons, yet demand, funnily enough, from our benign economic conditions, has been relatively strong from corporates that need to be in the centralised areas of a CBD to undertake their business. So we've seen some very strong rental growth, and that's translated through not only to valuation and the book value or share price as well, but to the growing dividends from the office dominated REITs. And then when you get into the retail sector, we are of course in a low sort of economic environment. GDP growth's moderate, wage inflation is quite moderate, and CPI is moderate, and then you've got the structural backdrop of online retail. So online retail has been growing tremendously, but it's started to sort of plateau at around that 8-9% of total retail sales. Nevertheless, it's been taking a greater share of the consumer's wallet. So people are more likely to say buy something online than they were many years ago. And some shopping centres have taken the hit on that. Very much the case that the shopping centres in the best locations with the best spread of retailers, like a Chadstone, are performing really well.
So you guys really take a deep dive when you look into different companies and what they do. And what I love about it is, so with listed real estate investment trusts and investing into these kinds of things, is that you can do it with any sort of dollar amount. Whereas you look into your general residential property investor, they might have a smaller capital balance that they can allocate towards a property portfolio. But when we start comparing the assets that you invest in, you're really allocating towards an income play, and you want an income, which can draw probably the best comparison to someone that invests in commercial property. Someone that might buy a factory that might generate a 7 to 10% yield, might have high risk factors, or someone that might look for a longer term play, might want to own the building themselves. And hold it on a 15-year lease, but might be looking at the moment at between a 4 and 6% yield. How do you see what you guys do different to, or better than, how people invest into these commercial assets?
Sure, Stefan, that's an excellent question. That's really at the crux of what we're trying to achieve and deliver with our funds. But not only that, the real estate investment trust proposition, at its essence in this country, is basically one about diversification. And one about liquidity. So you hit the nail on the head. You can invest for as little as a share in a company, or a minimum in our fund is $1,000. And for that $1,000, hypothetically, you can get a piece of about 2,500 to 3,000 different properties, commercial properties across Australia and some offshore. So think about the tenant risk associated with that. You might have a multiple of that number of tenants across that whole portfolio, and you can access it for as little as $1,000, hypothetically. Step that back to what you were just talking about. If you want to buy a factory, say in Fawkner, that might be leased to a manufacturer, a cabinet maker, it might still cost you $800,000. It might yield you about 6 to 8%. But obviously there's a lot more risk that you're putting not only in capital but in the tenant as well. So if that tenant packs up and leaves, then you've got a massive income hole.
You need to be able to have the money there to fund it through, make the interest repayments on it, until you find someone new to come in, which obviously generates advertising costs and things like that. But these companies that you invest in, they take care of all that.
That's exactly right. And given the assets that these real estate investment trusts that are listed own are some of the best that exist. So for an investor to get access to that quality of, say, a tenant covenant, they'd have to spend millions and millions of dollars. You're not, if say you wanted to take that industrial warehouse in Fawkner to the next level and you want to go and buy something in the southeast of Melbourne that's leased to, say, Toll Holdings, that might cost you $50 million. To access that quality of covenant, you've then got to really up your ticket size.
It's some interesting stuff. But obviously, so it sounds like a great investment, and in Australia we love the property story, that it always keeps growing, it's never going to go down. Tell me about some horror stories that you've seen when it comes to these listed Australian property companies.
Well, when it comes to real estate in Australia, when I tell my family and people that I meet what I do, they immediately ask, so what do you think of the residential market?
Yeah.
Real estate in Australia is somewhat of a hobby.
Yep.
It's a sport.
Yep.
But when it comes to commercial property, it's relatively simpler, but it's not easy. So one of the horror stories, I suppose, that's fresh in everyone's mind is the GFC and the impact that that had on the real estate investment trusts.
Mm-hmm.
A number of the REITs, many of which don't exist anymore for a number of reasons, found themselves in this perpetual circle of gearing up, so taking on a lot more debt and taking on a lot more risk. So for an example, I think the average level of debt, or indeed debt for some REITs, would have gone through to the 60% loan to value. Whereas at the moment, the gearing across the AREIT sector is less than half that, so probably about the 28%. Mind you, that was through the GFC where interest rates were at a much higher level, but they were investing for high growth. Not only that, the debt they were taking on was short dated.
And that's where you see a lot of these companies start to fall over when their debt levels are too high.
Yeah.
The market takes a bit of a back turn.
That's
and
right.
they just can't fund the repayments.
Yeah, so they took the view, a lot of the REITs in the GFC, that, I'll take relatively cheaper short duration debt and just roll it over. But it came to a point where that debt market was frozen, not available anymore, so they had to issue equity to recapitalise their balance sheets.
Yeah.
But at the moment,
and what that basically means for everyone out there is they ask the investors for more money.
Yes, at a very low price, at a time when a lot of people weren't too confident in how they'd managed.
Yes, they wouldn't reinvest again.
That's right.
Yeah, okay.
Step forward to today, and you've got REIT balance sheets that are in a very, very strong position with less than half the level of debt, but also that debt is long dated and there's a higher degree of fixed debt as well. So if interest rates go up, the REIT's debt cost is relatively low because they've paid to fix the rate. And of course the debt that they take out could be 5 to 10 years in duration. There's some REITs offshore that take out, accessed 20-year debt facilities at a relatively fixed cost.
Right, so we're talking about some pretty big numbers, some pretty big debt levels, but they're obviously trying to keep the debt down.
That's
which
right.
is why you make your full-time job to make sure you're assessing companies properly. And as a company, your company handles, $1.6 billion of people's money?
Correct. All invested in the Australian and Asian real estate investment trusts listed market. So in Australia, we've got about $1.6 billion. And of course, that's mainly in our AREIT fund.
Right, so managing $1.6 billion, you can't just go into one company and trust that one company. You obviously spread it out. So is your portfolio always changing?
It is, yeah. Look, it's an actively managed fund. We own probably 30 odd positions on average. At the moment, we might have around there. Obviously, part of delivering a solid, sustainable income distribution to our investors that's low risk, you need to be diversified.
Yeah.
So we obviously make the assessment to own more or less of some companies, but a number of companies nonetheless that will give us a spread across size for liquidity as well as sector and market that we think will get the best exposure to and deliver what we're trying to for our investors, which is a low risk, high relative income return.
Yeah, beautiful. So based on that, low risk, high income return, leads us straight into what is the type of investor that you think would normally invest into Australian listed real estate investment trusts?
Well, look, it's basically an investor that's focused on maximising their income. It's not for the investor that thinks, I'll make a quick multiple on my ingoing investment. I'm happy to wear a heap of volatility, but I want a quick, sharp gain of 50, 100%. The APN AREIT fund's probably delivered, low teens, mid-teen per annum returns over the last 5 years. But mostly we target an income return. At the moment, it's yielding 5.95% per annum. And we say to our investors, if you can get the income return plus a CPI-like or better than CPI-like capital growth over a 5 to 7 year period, puts you in the 7 to 9% total return range. That's basically what you should be investing in our fund and the REITs for. Yeah,
and approx 7% would be doubling your money every 10 years. So that's a good little way to put it for everyone else. So there you go. You've learned a little bit about investing into listed Australian real estate investment trusts or listed Australian property companies as well. Mark, thanks a lot for coming on, mate. Look on for next time, and hopefully we'll have him on again in the future.
Thanks for having me, Stefan. It's been a pleasure.